Hello everybody, my name is Teresa and I want to welcome you to this new RankiaPro interview. And today we say hi to you from the beautiful Hotel Meliá Plaza in Valencia, España, where we have a very special guest, Kevin Thozet from the Investment Committee of Carmignac. Good morning, Kevin, how are you?
Morning, Teresa.
It's a pleasure to meet you. How are you liking Valencia?
Well, it was very nice, despite the weather.
Yes, I know. I'm so sorry for that. So we are very happy to welcome you to our hometown. And now we're going to talk about a lot of things, asset classes, central banks, inflation. So are you ready?
Yes, I am, yeah. Many things to be discussed.
Okay, so let's start this interview. And the first question is, how would you describe the global macroeconomic perspectives for 2025?
I'd say one of the main characteristics for 2025 is that as we entered the year, expectations for the US economy was very high, so very high optimism among economists and investors alike on the US economy, and conversely, very strong pessimism on Europe and on emerging markets, notably Latin America and Asia. And in fact, as we advance in 2025, chances is that the balance will refocus with, I'd say, the risk is for lower economic growth in the US and for better growth outlook in Europe and in several emerging markets, notably China.
So let's actually go to Euro now, because there is some structural challenges in Germany and France. Mm-hmm. So I wanted to ask you, how do you think this will affect the market in Europe?
Yes, clearly the starting point is not very rejoicing. We are in France. We are in a, let's say, lesser profligate fiscal spending, so deficits needs to be addressed. They remain very important, but we will see less of a fiscal impulse in France, so that's one. The second one is that political uncertainty has an impact. It has an impact on companies' willingness to invest, because the political majority in France remains a very fragile one, and everybody all the future governments of France will have this Damocles sword until the 2027 election. So this gives, let's say, a growth environment which is not that positive for France. So that's one. For Germany, for different reasons, but we also coming out of, let's say, 2 years of economic growth flirting with zero, and I'm being generous, flirting with lesser than 0%. But if I were to see kind of the glass half full, or there's some form of light at the end of the tunnel, and notably because those 2 years of, let's say, recession or recessionary pressure in Germany has led to significant changes in public opinion, and notably with all that is linked to the German government capacity and willingness to spend, what we call the debt brake. The German law has a very restrictive approach to fiscal spending, and hence very low deficits, and this has been weighing on growth. 6 months ago, 9 months ago, if you were conducting a survey in Germany, most of the public opinion was against changing on this debt brake. Today, things have changed, and there's an increasing willingness within the German population to, let's say, stimulate growth more. And this has had an impact. We have had some elections in Germany, so where we had likewise, let's say, a weak government or very large coalition, sometimes for political parties which were quite of the exposed side of the political chessboard, which has made it very difficult in Germany to implement some, let's say, long-term policies and long-term positively growth policies. Those are changing as well. And we are seeing now a new coalition. It's still up in the air, but the probability that we will have more spending in Germany is rising materially. So here again, I think the dynamics are important. The starting point is low, but going forward, things can improve from there.
Mm-hmm. Thank you, Kevin. And what can you tell us about the role of China now that it seems that it's recovering? What do you think is going to be its role in 2025 in the macroeconomic landscape?
So, I mean, what we have seen, and it's likely another, I'd say, key or strong marker, strong characteristics of 2025, is that the US economy is centering back on itself. So isolating itself, if you will, from the rest of the world. This has had an impact on Europe. It will mean that Europe will have to do more, notably on the defense side, and it has had an impact on China as well. It's true that what we have seen is that very strong performance engine or growth engine for China has been coming from exports. So China exporting, cheaper, let's say, televisions, cheaper electric vehicles, and the likes. With the rising risks of tariffs, this means what? It means that Chinese policies will have to be centered more on domestic policies and more on the domestic consumer in China. Beginning of March is what we call the two sessions. So where we will, again, likely see the vindication of all the measures which have been announced past September. So again, I think on China, Chinese authorities have put a floor on how low economic growth can go. And what we can expect for 2025 is, let's say, GDP growth targets by Chinese authorities of 5%, more fiscal spending, and easier monetary policy. So to help the Chinese economy and notably the Chinese consumer.
Thank you, Kevin. Okay, so we have Europe, we have China. Now, obviously, we had to go to the United States. Now that Trump has returned to the White House, what do you think is going to happen? How do you think this is going to impact the global landscape?
Yeah, so it's clearly it's a major factor, a major source of uncertainty. I think the impact in the US of the new Trump administration can be summarized in 3 points. One is that the exceptional growth we have seen in the US in the aftermath of the COVID has been almost entirely explained by one factor, which is fiscal spending. If I'm looking at how economic growth has evolved in the US, it has grown in nominal terms by something like 8% per year since COVID. If you're looking at how the deficits have evolved, well, they have evolved by a similar magnitude. My point there is that almost the entirety of the US economic growth environment, exceptional growth environment, has been explained by exceptional fiscal measures. What we have with this new administration is the famous DOGE, advised by Mr. Musk, which is targeting at what? At reducing deficits, so at reducing federal spending. And this means what? It means that if you're reducing fiscal spending, you're reducing a strong engine of growth in the US, and hence the risk is that economic growth will be lower in the US. So that's one factor. The second one is linked to tariffs. There are, I think, still debates out there around whether Mr. Trump is using tariffs as a reality or it's a tool to negotiate. I think the jury is still out on that front. And I think that even without taking a strong view as per whether tariffs are a reality or merely a threat, it has an impact. And the main impact is the rise in uncertainty. And the rise in uncertainty, again, is very important because it negatively affects consumer confidence. It means what? That consumers are less willing to spend. And it negatively impacts the corporate world as well, because CEOs, financial directors are less willing to invest because they live in a very highly uncertain world. And this also has a negative impact on economic growth. And I'd say there's a third one. And the third one is that, in fact, in the US, what we have is that we have very low savings rates. So here in Spain, savings rates are around 10–15%. So they're relatively high. In the US, it's around 5%, so relatively low. What does this mean? It means that, in fact, consumers' willingness to spend is very much linked to the price of real estate, the price of equity markets. And if we have, let's say, a negative shock or financial markets which are downward oriented, this will affect, in turn, consumers, and hence will also kind of weigh on economic growth, with what we call the wealth effect. Lower wealth effect, lower propensity to spend, and the US consumer is 70% of the US GDP. So I think, again, in dynamic terms, the risk or the growing risk in the US is that we'll be talking more and more about a recessionary pressure in America.
Okay, so speaking of Donald Trump, there has been some tensions between him and Jerome Powell, the president of the Federal Reserve. So do you think Jerome will listen to Trump and he will continue to cut interest rates, or do you think he will not?
Well, for now, when we're looking at the Trump political agenda, let's say there's two main types of measures. Measures which have kind of a stagflationary impact, so negative on growth and upward positive, but let's say upward risk on inflation. Those are linked to the Doge, so basically firing or reducing federal spending. Second one's linked to what Mr. Trump sadly calls deportation, and the third one is linked to tariffs. Those three type of measures have a stagflationary risk embedded to them. And then we have other type of measures, which are more, let's say, what we call Goldilocks in our jargon, so positive for growth and with lower impact on inflation, linked to tax cuts and with deregulation. For now, Mr. Trump is more focused on, let's say, the political side of his agenda more than the economical side. So we would tend to think that, yes, the independence of the Fed, or we don't expect Mr. Trump to strongly interfere, let's say, with the Federal Reserve for now, even more so because the mandate of Mr. Powell will be coming to an end relatively soon. So it's potentially a source of uncertainty, which is likely to be on the side. But again, with Mr. Trump, you never know, or you're never sure what you're going to get down the road. For the US monetary policy, because I guess this is part of your question as well, market participants are expecting something like one to two interest rate cuts this year, which seems fair. Again, we would tend to think that the risk is tilted to the downside, so that in fact the US economy will not be as strong as it was. So the probability is that in fact we get more interest rate cuts than what is being priced in today, and hence there's kind of value in being buyers of those US government bonds on 2 to 5 years maturities.
And what about the BCE? Will they cut rates?
So I think for the European Central Bank, there's a similar type of environment. If anything, the European Central Bank will cut interest rates more than what is being expected if there's some downside risk on growth. The European Central Bank has conducted, since the month of June, almost as many cuts as there's been central bank meeting or governing council meetings. Going forward, the risk is that they cut at a pace which is lower than this, so maybe not one every meeting, but one every 2 or 3 meetings. Why? Because we're approaching what we're calling the neutral rate. It's a bit like when you're driving a car. When you're approaching your cruise limit, well, you stop accelerating and you wait to see the state of the European economy. What we think within Carmignac is that, in fact, the main risk for the European Central Bank is, again, that the economic cycle is doing a U-turn, and hence that they will have to cut more. As such, we also think that there's value in buying those bonds of well-rated government issuers in Europe, and on top of which it marries well, let's say, with more, let's say, performance-generating assets such as equities or credit.
Okay, thank you, Kevin. We will keep an eye to see what the BCE and the Fed do this year. Now let's change a little bit the topic. Let's talk about asset classes. What do you think are the most interesting asset classes for the 2025?
Well, what we are describing is, let's say, a relatively uncertain economic environment. So in such a context, on the equity side, we would tend to say that investors should favor or pay more or praise either companies and sectors where we can have some form of visibility. So that's one. So you can think of the technological sector, the healthcare sector, long cycle industrials typically. So that's one. Within the equity world, we would tend to again think that there's value in diversifying assets. So US companies are great, but there are great companies in Europe as well, which are trading at a lower valuation multiples, and this opportunity can be made the most of. And thirdly, in emerging markets as well, there are pockets of innovation in Latin America, in e-commerce, for instance, in China, in the tech sector as well. But equity markets are kind of, a long-term view. If you're focusing, or for investors who are more kind of focusing on a shorter-term horizons for 2025, well, I think there's potentially something in the middle between equities to generate performance on the one hand and sovereign bonds to generate some form of cushioning on the other hand, and that is credit markets. Within credit markets, investors and well-run fund can generate or we can build a portfolio with a yield to maturity of somewhere between 5 and 6%. And 5 to 6% of yield to maturity is very interesting. It's almost the long-term potential performance of equity markets, and with much, let's say, lower volatility. So that's how I frame it. Risk assets on the one hand, equities for those with a long-term horizon who can digest volatility, for those who are more risk-adverse, credit, and then on the side of this, I would tend to favor, let's say, safe haven, and we have again found some diversification or some protective potential within US bonds or basically German bonds. So that's kind of the core of a portfolio. And then to diversify, I think I was mentioning emerging markets. Emerging market debt can be an area where, in fact, there will be kind of lesser upward pressure on US rates. So that's positive for the asset class. And there's a decent carry there. So we can think of countries like Brazil, for instance, with very high level of yields, very low valuations, so the potential to digest, I'd say, bad news. And in other, I would say, overlooked assets, I think inflation-linked instruments can also be of value, because expectation is that we will see no more inflation in Europe. But if we do get some fiscal spending, if we do get Germany to spend more, if we do get more reflationary measures, if we are living in a world where it's less efficient and each economic bloc is more focused on itself, this will come with higher prices and hence higher inflation.
Mm-hmm. Well, I'm sure our investors have written it down right now. But what about the private markets? Because they seem to be living like a very expansion lately. So what do you think is the role of private markets inside the portfolio?
Yeah, again, I mean, our job is to try and generate a superior return over the long term. We have seen, let's say, over the past year, a growing attractiveness of secondary markets in private equity, notably. So where strategies which are kind of providing liquidity to some investors can benefit or can buy some very attractive assets at lower valuation. So that's an area where we would tend to invest. And then on the private credit side, I was alluding to the type of yields that we're capable of generating ourselves within our credit funds or within the credit sleeves of flexible bond portfolios. Well, in fact, with a 5 to 6% yield, that's the performance potential of those private credit assets. So I think private equity, and notably on the secondary side, there's value to be extracted from it. I think on the private debt market, private credit markets, with well-run portfolios, you can generate this without sacrificing on the liquidity side.
We talked a little bit just about the artificial intelligence. I wanted to ask you, how do you think the famous or the infamous DeepSeek will make the investors rethink about what they are doing in their portfolios and their allocation in artificial intelligence?
Well, I think it has already changed the way people look at it. Why? Because artificial intelligence and the boom in stocks around artificial intelligence has been built around three main factors. One is that we will have a huge compute power, because artificial intelligence is a real industrial revolution. So it will need lot and lot of compute power to be able to satisfy this. The second element was that, in fact, only a handful of companies and only a handful of US companies were capable of providing this. And finally, that this was relying on what I call the magical card, and that's the NVIDIA GPU. With DeepSeek, I think, but not only DeepSeek, with other, let's say, language models in China, in Spain, in France, in Canada, comes the realization that, in fact, innovation is not just for the US, it exists elsewhere. So that's one element. And that, in fact, we can basically have, let's say, a similar type of service or similar type of computation, but at a much lower price. If I use the analogy of the car again, the Amazon, Microsoft, Meta of this world, they were building Ferraris. You know, super data centers, great compute power, gigantic, very, very efficient. But to get from A to B, a Ferrari is very good, but you can drive a Honda or a Seat, and it works as well. And my point there is that with DeepSeek comes this realization. And hence, what we expect in artificial intelligence is that with the emergence of those new language models, typically, the cost is being lowered. With the lower cost, adoption rates will be greater. So more and more industries will be using artificial intelligence. So what we will have is still significant compute power, but the two other factors behind the frenzy around AI, maybe there will be less linear, or maybe there will be kind of more space for other players to benefit from it. And this is something that we are seeing in China, for instance, a company like Alibaba, they have their own artificial intelligence model, they have their own cloud service, and they have applications. They have AliExpress, where they can use, for instance, artificial intelligence to boost the sales on their platforms. And those companies are trading at much lower valuation multiples than US stocks.
Mm-hmm. Thank you, Kevin. So artificial intelligence is going to be very important for the development of the investment field. Another asset class that is rising is gold. Its prices are breaking records almost every month. So I wanted to ask you what you think about this, and also how can the investors gain exposure to this metal?
Yeah, so the environment, or the economic environment that we are describing, and even more so with the kind of rising threat of tariffs, is one of the worst world in the financial community. It's not recession, it's stagflation. So higher inflation and lower growth expectations. And in such an environment, gold tends to be faring relatively well. Obviously, and I think this is increasingly obvious to investors, and hence the price of gold have gone up a lot in such an environment. So we continue to allocate a portion of our investments in gold, and that's true in cross-asset funds, in equity funds as well. But we are somewhat reducing exposure to gold, so taking some profits and using other financial instruments to get exposure to this kind of stagflationary risk, and notably, let's say, inflation-linked bonds, which can help, notably via the different components of inflation-linked bond, and notably on the break-even components of such instruments, which are much lesser valued than gold itself.
Very, very interesting. Thank you, Kevin. It seems like we cannot escape the United States lately. I want to come back to it just a little bit, because I was wondering, what do you think is the future of ESG investment? Now that Trump is implementing some measures that seem to go a little bit against what has been done until now. So I want to ask you, what do you think is the future of ESG in general, not only in the United States, but also in Europe?
I think ESG is here to stay for several reasons. And obviously, the US is kind of dialing back on this, or Mr. Trump is trying to dial back on the Inflation Reduction Act, or various measures of the previous administration. So this is kind of moving backwards. But in other areas, ESG is moving forward. And it's notably the case here in Europe. I mean, the European authorities will have to be creative to respond to the US isolation, let's put it this way, and they are already moving forward. So what we are likely to see is that we have had, in the aftermath of the COVID, some very strong measures, and with the Next Generation EU fund, which was kind of fiscal spending with an ESG tilt to it, and we are likely to see going forward, is that we will have this clean industrial pact, and here again, where European authorities will invest something like 150 billions of euros in clean industry. And this is very important. Why? Because one of the problems that we have in Europe is that the price of electricity is very high, much higher than what it is in the US, much higher than what it is elsewhere. And with such measures, with this kind of clean industrial pact, what we are likely to see is is to try and lower the cost of electricity, and this will help lots of industries, notably in the old industries in Germany, whether it's chemistry, whether it's in the manufacturing side as well. And so this will be very positive globally for the planet, but also for the economy, we think. Besides, we have been talking about innovation and artificial intelligence, and there's lots of innovation in Europe, not only linked to artificial intelligence, and this will also, I think, benefit greatly those companies. So we can think of giants like Ørsted, Siemens Gamesa, Iberdrola here in Spain, but there are many more across the continent.
Okay, thank you very much, Kevin. Thank you for all your insights. This was the last question of this interview. And from RankiaPro, we want to thank you for finding the time to be with us today, because I know we're very busy, so thank you very much.
Muchas gracias.
And thank you to all of the investors watching. As usual, please don't forget to share this interview in LinkedIn and follow us on all of our social media. See you next time. Goodbye.